Hey, Bulls and Bears. It is Sunday. It is July 23rd, 2023, and back with another dose of economic reality slash economic collapse news update. And we've got a big week ahead. Let's go ahead and get started right here. And let's talk about the stock market. We've got the Dow Jones with the longest winning streak since 2017, right? Nobody here should be surprised by this. We have unlimited debt capabilities now. There's no debt ceiling. The debt ceiling's actually been suspended. I think most of you know that. So, how much of this money is going right into the stock market? That would be the one question I don't think anybody knows. But two, are investors just that much more confident now that there's all this spending that can happen, unlimited spending, no debt ceiling, right? This is uncharted waters, folks. So I wouldn't be surprised to see stocks skyrocket, but then all we have to keep an eye on this too. We have to think about the risk out there, right? So we have the risk of war right now. We have the risk of the consumer going broke, and people draining their checking accounts now. And it's not going to be good as far as the consumer goes. Can they keep the stock market even as the consumer goes broke? Bankruptcy storm for the consumer, absolutely. But it's going to be very revealing if the stock market doesn't correct when 90% of consumers are plunging into the depths of just debt despair. Right. So how much longer and how much further can they disconnect the stock market from economic reality, which is the U.S. consumer and most people here in the United States? The US dollar has lost 85% of its value since the 1970s when the dollar was decoupled from gold. And the government seems bent on continuing the tradition. From now until the next elections, the government can print as much money as they want. The last time they did that, inflation went up 9%. This means one thing: the security of your future and your family's future is all in your hands. Make sure you freeze the value of the wealth that you're holding. Invest in gold with Noble Gold Investments. Gold is the one asset that is proven to withstand recession, inflation, and just about all other economic threats. Noble Gold Investments is here to help you if you want to invest in gold. You'll also get a 24 karat quarter ounce gold standard coin for free. Go to bullboomgold.com now. That's bullboomgold.com. Link down in the description of this video. Noble Gold, the only gold company that I trust. There's always a risk of investment and there's no guarantee of any kind. All right, next, let's get into a little bit of good news. People say, sometimes they say, I don't have good news. Well, here's good news. If you are lucky or skillful enough to have money to invest or to save, CD rates now are approaching 5.75%, as high as that, I should say. Not all the CD rates are, but you can find them if you look around. 5.75%, which is very good if you look back over the last 20 years. Now that's still nothing compared to the 80s when you could park your money in an account or a CD and get 15% plus. There was a point in the 80s where you could get 15% on your money. The problem that I've pointed out here is many people just don't have the money to put away now. The savings rate is near record lows. We're talking about near all-time record lows. And I like to remind people here, if you're someone that's saving money each month, meaning putting more money away versus going further into debt, then you're in a very small fraction of the population. Some people actually go further into debt while still saving money. To me, that doesn't make a lot of sense, because if you're paying interest on that debt, especially if it's high interest, if it's a credit card and you're paying 20% and not paying it off in full each month. So in other words, you're saving money over here, but you're losing even more money over there because you're paying all these interest fees every month. That doesn't make a lot of sense. So it's nice to say, yes, you have some savings. It's good to have an emergency savings, amount put aside. I recommend at least 30 days out of the system, or at least 30 days living expenses, preferably 6 months, but at least 30 days at bare minimum. So if you're doing that, but yet paying all these interest charges, it doesn't make a lot of sense unless you just want to have some set aside for an emergency, which I can understand that a little bit more. You also put your money in a money market right now. Even a lot of retirement accounts, you can get 4 or 5% now with money markets in your retirement accounts. I know that Fidelity offers those. Other big employer-based retirement accounts are also offering those. So pretty good time to grow your money. The problem is Are you still paying tons of interest on this debt that you're not paying off? That's the big, thing I want people to look at. If it's a mortgage and you took it out, back when mortgage rates were low, then don't pay it off because you're making more now on interest than you're likely paying in your mortgage. For those people that got in at 2.7 and 2.9%, those rock bottom rates. Also, back before the big rate hikes, we saw even car loans were being issued at 2.5%, 3%. Sometimes dealers even offered 0% financing, which was pretty amazing. If you're still in a 0%, obviously that's a no brainer. You want to go ahead and just make the minimum monthly payments on that type of very low interest rate loan, and then allow yourself to make more money on your savings by growing your savings versus paying off debt, holding that cash. All right. So something to think about as interest rates are higher now, we kind of have to adjust our perspective here on where to park our money, safe investing, all those things. Now, when it comes to CDs, I'm not a big fan of CDs. I don't like having my money tied up. I've had CDs before. One time I took out a 1 year, 12-month CD. And this is back when I didn't have much extra money, but I wanted to at least make some money on my investment or on my cash, sitting there. So I put it in a CD, and sure enough, 3 months later, the stock that I had been watching for months dropped on some bad news about a report that came out about some of the testing they did. It doesn't matter anyway. The point is, when I had my money tied up, I couldn't put it into the stocks. I didn't have any extra money or enough extra money to invest like I wanted to. And my money was then tied up in the CD, right? So that's one of the reasons why I'm not a big fan of CDs. If you're not an investor who may need to pull the money out at some point for a nice investment that shows up, or some asset, that corrects in price and you want to go buy some, then CDs are not for you. But if you're just a passive investor, or not even a passive investor, if you're just someone that likes to park your money, then the CD may be for you, to each his own on that. All right, let's transition a little bit here to another side effect of the current economic situation where the cost of living is plunging most people into debt despair. We have, of course, rising homelessness. And there's a really good example here. A recent story just came out on the 21st here. Large fire breaks out at homeless encampment right in the heart of Seattle. Look at this right here in these trees, if you can see the fire. So it used to be thought that, homelessness, out of sight, out of mind. If it wasn't in front of you, you wouldn't have to worry about it. You don't see it. But now this is right outside of a major hospital, and you can see the line of trees down here. And this was reportedly a homeless encampment where who knows what they were trying to cook up in those trees there. But you could see how close the fire is to all these big buildings. And they had to come, of course, an emergency fire response to put it out. And here's a more close-up picture of the fire scene there in Seattle. And it's reported here the Seattle Fire Department responded to the fire located just south of the intersection of 7th Avenue and James Street at around 5:25 a.m. The fire was burning in a wooded area north of Yesler Way between I-5 and the Harbor View Medical Center. Right? So it's not just in out of sight places anymore. It's in the parks. It's at our outside of our stadiums here at Petco Park in San Diego. You can see homeless everywhere. It's right outside hospitals now, medical centers. So it's this problem is encroaching closer and closer to just normal people just trying to do everyday things like go to the medical center, go to a baseball game. And obviously with the cost of living just getting worse and the inflation problem getting worse, this problem is going to get only worse. Next, according to a new poll about retirement savings, nearly half of Americans say they can't save for retirement. And that's what I was talking about at the beginning. If you're someone that's saving money versus going further into debt each month, you're in a small percent of the population. Now, this poll that was taken here, nearly half of Americans say they can't save for retirement. How many of these people are just taking on more debt each month just to stay alive, just to maintain a normal lifestyle? And looking through this article here and some of the people they talked to in this poll that were included here, about 20% of people feel like they're never going to be able to retire. Never. That's pretty sad state of affairs to think about never being able to retire. If you're not saving money each month, I mean, how are you going to retire? You have to maybe rely on Social Security or something like that. Speaking of unable to save money and debt and credit cards, I want us to look at this chart here. This is the percentage of domestic banks that are tightening standards for credit cards. And we look to the right side here of this chart, and we could see the percentage of banks tightening. We're right between 20, so it looks like just over 30% right now. So just over 30%, and we have a lot of the population now living off of credit cards. So what's this going to mean when it's half of banks that are tightening their credit card uh, loans, so to speak? What if it's going to be 70%? What if all banks start restricting credit lines? How are people going to survive? So that's the first question. Or will that be the solution? Because the less money people can spend, maybe we'll start seeing prices come down. Remember, the more people can swipe credit cards and buy things that they can't afford, the higher the prices go up, right? So if you're a retailer and you're selling out of merchandise because everybody's coming in and just buying stuff on credit cards, what are you going to do? You're going to raise your prices, right? If nobody's buying it, if it's just sitting on the shelf, it's pretty simple, right? You're going to lower your price. So maybe tightening of credit will be the solution. We're talking about one more possible rate hike coming up in July. Many people are out there speculating that that could be the final rate hike. So it means you're going to start cutting rates soon. Is that what it means? Or are they just going to hold rates steady? It's very interesting, though, that they would talk about even holding rates steady when the war has not been won against this outrageous cost of living. Now, still on the topic of credit cards, I've got another interesting chart here. Take a look to the right side of this chart and look at the spike in these credit card interest rates over here just over the past few months compared to, let's say, 2008 financial crisis. We saw the rates rise up to about 14%. Then, of course, the recession slash great financial crisis kicked in, and credit lines dropped. People stopped spending money, and of course, we saw interest rates get dropped. Credit card rates dropped. Look where we're at now, though, compared to back then, right? So, rising rates back then was one of the factors in kicking off the financial crisis, and we were under 14%. Now we're approaching 21% on credit cards with people in record levels amount of credit card debt. All right, folks, it doesn't take a genius to figure out what's going on. It's not as easy to figure out exactly how to position ourselves. But I would say be careful with how you spend your money. Think about having savings put away in case, the straw that broke the camel's back shows up pretty soon, which I think it's going to. And, people are going to wish they had some money out of the system here when this whole system comes down. We could wake up one morning. The question is timing, right? So you don't want to spend your time hunkered down in a cabin somewhere out in the woods because of economic collapse. But at the same time, you want to be in a position to, survive this and hopefully thrive through this and maybe even make money through this. Ultimately, we're going back to hard money. It's going to be gold and silver backing our financial system. We've got this big announcement coming up in August out of the BRICS nations. We're going to see how the precious metals and how gold specifically is going to be implemented within their financial system. If you look at all the BRICS countries now, they make up most of the GDP throughout the globe, right? So it's going to get very interesting. We've got a lot of things to keep an eye on, a lot of balls in the air, so to speak, to try to juggle here, just to at least keep an eye on. But if you come back to this channel, we'll keep you on top of the most important, relevant news globally, locally, your money, my money, investing, you name it. We'll talk about it. Come back for more news updates. Please subscribe to this channel if you're not. Seems like there are some forces out there that may not want this channel around. So that's all I can say about that. But thank you for your support, everybody. Big love. Keep stacking. Bye for now. Peace.